The RBA Central Bank has raised interest rates by 50 basis points for the second month in a row. This is now its third rate rise on the trot. And like many central banks around the world, is trying to navigate inflation. Though, of course, over this past period, it's been interesting to start to see this growth and demand discussion come into more play. As we know, central banks are trying to work out how they can raise interest rates effectively, put the brakes on the economy and navigate this soft landing without, of course, inhibiting growth and sending the economy into a recession. Today, we got some more commentary and discussion from Phil Lowe, the RBA's governor, and it gave us an insight into what the Reserve Bank of Australia and other central banks around the world are thinking through this uncertain macroeconomic environment.
Sit back and enjoy.
And so here we have it. This is the statement by Philip Lowe, the Reserve Bank of Australia's central bank governor. It surrounds their monetary policy decision for July. Of course, it's always in the first week of the month. And it's worth noting as well that the decision is not only about inflation now and the current lay of the land, but it's about the inflation expectations that they do not want to see embedded because of the risk that the wage price spiral, really that circular type of discussion, can lead to as these expectations become embedded into the society's psyche. So as we can see here, some of the key takeaways. Global inflation is high. It's being boosted by supply disruptions. We all know about the bottlenecks. We know about the situation in Europe and strong demand, which is putting pressure on productive capacity. Monetary policy globally is responding to this higher inflation, though, of course, we're still yet to see where peak inflation sits. We saw potentially initially when interest rates went to 8.5% in the US, then back down to 8.3%, there was questions about peak inflation, but of course we've risen above that now. So we're waiting to see where is peak inflation and then where will that more neutral level inflation start to subside. Of course, central banks are targeting that 2 to 3% band, but we're not going to return that immediately. And so it's going to be quite fascinating to see the story of how it does evolve. Inflation in Australia is high, not as high as it is in many other countries. Global factors account for much of the increase. We know that a lot of the pressures from inflation are supply side. Of course, monetary policy is a blunt tool. It acts with a lag, but obviously it's more difficult to target that supply side inflationary effects as well. But they've highlighted domestic factors are also playing a role. Strong demand, a tight labour market. We've got a 3 handle on unemployment at the moment, 40 plus year record lows for unemployment, and capacity constraints. We all know about agriculture. We know about the energy sector as well, all contributing to put this upward pressure on prices. Inflation is forecast to peak later this year. We got an insight into the potential of that. Phil Lowe stated that they expect a potential 7 handle in front of it towards the back end of this year, and then declining back towards that 2 to 3% band next year. So it's interesting they have provided this forecast for us. But what's fascinating is we know we get a lot of data coming in the back end of July. The RBA and Australia operates on a quarterly basis for some of these key data prints. Other central banks and other nations around the world like the US and UK operate on a more monthly cadence. But we'll get the June quarter at the end of July, and then we're going to get a full set of updated forecasts next month. So that'll be interesting to see. The Australian economy remains resilient. The labour market's tighter than it has been for some time. 40 plus year unemployment, as we mentioned, lowest rate in almost 50 years. Underemployment has fallen significantly. Job vacancies and job ads are both at very high levels, with a further decline in unemployment and underemployment expected over the months ahead. I'm sure for anyone who's been working, and whether it's your company or your small business, there's a lot of job vacancies out there and it's hard to find the right candidates, and you can see that tight labour market coming through. What's interesting as well here is that one source of ongoing uncertainty is the behaviour of household spending. We know there's that $200 billion war chest save up by households, as we saw the household spending rate go up to 20+% during 2020 and 2021. It's also interesting to think about the fact that there's going to be those tax offsets that were offered by the government that will come through now. We're at the end of the financial year. So it'll be interesting to see if spending can remain resilient in the face of not only rising cost pressures, but of course rising interest rates as well, which is going to reduce discretionary spend available. The board will be paying close attention to these various influences on household spending as it assesses the appropriate setting of monetary policy. They'll also be paying close attention to global outlook, which remains clouded by the war in Ukraine and its effect on the prices for energy and agricultural commodities. Real household incomes, which are incomes, and then when you strip out the inflation component of them, are under pressure. 5.1% inflation rate for Australia, likely to be higher with the next print. When you're talking 8+% rate prints, inflation prints, whether it's UK, US, other European nations, real incomes are struggling. Real wages can't grow fast enough, and so that's going to be interesting to see how that dynamic plays out. Today's increase in interest rates is a further step in the withdrawal of the extraordinary monetary policy support. So worth noting that, of course, this past period was anything but typical. As we went into 2020 and we saw the difficulties in the global pandemic and lockdown, central banks pulled out the toolkit and did whatever they were able to do, whether it's through quantitative easing, as well as, of course, bringing in record low interest rates and a coordinated fiscal support as well. But we're now slowly removing these supports and getting back to more normalized conditions. So the resilience of the economy and higher inflation means this extraordinary support is no longer needed. And they've, of course, outlined and further forecast further steps necessary or likely to be necessary in the process of normalising these monetary conditions. It is going to be contingent on incoming data and their assessment of the outlook for inflation and the labour market. And they've reaffirmed this with a final statement. The board is committed to doing what is necessary to ensure that inflation in Australia will return to targets over time. Nobody knows how this story ends. It's going to be a fascinating one. Before we think about that, if you have enjoyed the video, easiest way to show support, subscribe, turn your bell notifications on. We do plenty of videos on the channel, so we'd love to have you join us here. But as we mentioned, they're going to be data dependent. Of course, the RBA doesn't work in a vacuum. Global economies are interconnected. They're going to be waiting to see what happens over in the US, over in Europe, and how things play out. Also looking on the supply side as well to see if we see a natural subsiding of the supply side pressures. Will supply chain bottlenecks start to ease over time? And will those oil prices and other key prices that are inputs into the rest of the economy start to come through? I'd love to know your thoughts. Drop in a comment. Let us know what you're thinking about it all. A big thank you for joining us. For now, stay well and happy investing.